Hey, Rick Mount with Fairway Independent Mortgage here, part of the Mike and Rick team, Mike Hardy and Rick Mount. And this week's quick facts, we're going to talk about, oh my, what the heck is MI? Well, in the mortgage business, we're great at speaking a foreign language using acronyms. And one of the most commonly used acronyms is MI, or short for mortgage insurance. So there's a couple of different forms of mortgage insurance we're going to cover real quick. FHA, for example, has two forms of mortgage insurance, often referred to as MIP, or mortgage insurance premium. The first portion of the mortgage insurance requirement under FHA is the upfront mortgage insurance premium that is typically elected by the borrower to finance it into their loan amount. It's a one-time fee that's included at the time of closing into their loan amount. The more traditional portion of MI, or MIP for FHA, is the monthly portion, and that's included in their regular monthly payment that you make each month. With the recent changes in FHA, it's important to know that the mortgage insurance requirement is now for the life of the loan. So regardless of what loan to value or how much equity you end up obtaining in your property at some point in time, the mortgage insurance is not cancelable anymore. There's a big difference between FHA today because of that change and conventional. So Fannie Mae, Freddie Mac, or the conventional loan offerings have different forms of mortgage insurance. One of the most common ones is the borrower paid premium, where the borrower pays the premium. There's two types of premiums that they can pay. They can either pay it in a single premium, which is a one-time fee at the closing, and it eliminates the normal traditional monthly payment. Or the more common one is the borrower paid monthly premium, where it's part of their normal monthly payment going on. There's a fancier version of this now called a split premium, in which the borrower can prepay some of it at closing and then have a much smaller portion of it monthly, and we often use this to help navigate into achieving a certain payment for a client or meeting debt ratio requirements. Another more common or popular option that is becoming more popular is the lender paid premium, or LPMI. This is where the lender will pay the cost of the mortgage insurance. They usually do this by raising the interest rate slightly to offset the cost to the consumer, but it eliminates both the upfront portion of the premium and or the monthly premium that the borrower would pay. So oftentimes we're able to stretch a borrower's purchasing power by using the lender paid premium. Even though the rate's slightly higher, it does eliminate a good chunk of the mortgage payment that's paid monthly. So as you can see, there's a lot of moving parts to this. It's important to know that mortgage insurance on the private side, the PMI for the conventional loans, can be canceled. So generally it's set through the Homeowners Protection Act to cancel after achieving 78% loan to value based on the normal amortized scheduled payments to be made. That's typically about 7 years for most loans. However, there are some servicers that make exception to that after a minimum wait period of 2 years if the borrower can prove that they've achieved that 78% loan to value by obtaining an appraisal at their own cost. So you can tell there's lots of moving parts. We'd love to help you navigate through this. We can help you make a healthy decision. We're here to help. Make it a great day. We'll talk to you soon.